So like I said, fast chart analysis, also run that on the SPY as well. All right, 4 to 6 candidates, that's pretty much self-explanatory. All right, to find gappers and dumpers in the pre-market, you can check various free sites like finviz.com or benzinga.com, various other sites. You can just look up pre-market stock gappers on Google, or you could go to subscription sites like briefing.com or benzingapro.com. Now you can also use the pre-market scan on the add-on scanner for ESignal. Now keep in mind that that's a extra fee. It's an add-on product. And the most easiest thing to do is if you have access to TV or CNBC, you can access them on the internet as well. In the pre-market, you can watch their ticker, and they'll show you the most active stocks trading in the pre-market. And keep in mind that with more volume and activity, there's going to be greater pockets of liquidity, and most importantly, you're going to have more participants. And it's all about participants. The more players you have in the stock, the more liquidity there's going to be. And it's the greater fool theory. There are going to be greater fools. All right. The most important thing is you don't want to step into stocks, number one, that you're not comfortable with, number two, that have very little volume and end up getting trapped. So make sure it's a legitimate gapper. All right. NYSE, NASDAQ, basically stick to those two. And as far as reading the earnings, basically just skim through if they beat the earnings per share and as far as their guidance. But bottom line is that your own opinion is not going to really matter. Okay, all that matters is the price action, the big boys, and wherever they want to take that stock, or they're going to be in control. The bazookas, the tanks are going to be in control, and your goal is just to follow along, all right, and find your spots of opportunity and take advantage of them prudently. Remember to stay loose and objective. Now, speaking of the add-on scanner, once again, it is a extra fee a month, so make sure you check. ESignal has various scans for the add-on scanner. The pre-market scan will give you a list of the most active stocks in the pre-market, and once you get that set up, you can click the new button on the main tab up top and click scanner, and then select the type of scan that you want, which is going to be the pre-market scan. Now, as far as scanning the hot lists, you can open up a hot list. That's not going to help in the pre-market, but as soon as the market bell opens, then you're going to be able to see on the percentage gainers or the point gainers, point losers, and instantly you'll have a nice matrix of stocks based on their change from the closing prices. So right after the 9:30 bell, you can always pull up the hot list and select the percentage or point gainers for NASDAQ or U.S. equities in general. And that'll give you plenty of opportunities and candidates to stalk, track, and look for opportunities. So, as far as playable gaps, okay, well, what kind of stock is playable? Okay, first of all, you really should be familiarized with the stock. All right, I can't really stress this enough. But look, no one starts off knowing all the stocks, okay? In fact, some of the best ways that you build your core list of stocks that you're watching and trading, and also your book, for your book, is, well, it's by meeting these stocks during periods of heavy stress, volume, that comes from a catalyst-based gap, okay? It's just like when you meet people, everyone's nice and stuff, but until you see them in a stress situation, that's when their true character comes out. So these gappers and dumpers, what's almost really nice about them is that you're meeting them in a worst case scenario, in a worst case gap up, in a worst case gap down, pure stress, and you get to see the fabric of their character, okay, and how the stock moves in a period of heavy volatility. And then that way, as the days go on and the volatility resumes back to normal, you'll realize, oh man, that stock really sucks during the, when there's no gaps. Forget it. You see what I'm saying? Forget it. Oh wow, Coors actually does move pretty good. Tiffany's oscillates pretty good. Oh, Microsoft sucks. That thing does not move. All right, and you get an idea of that firsthand. So in the beginning, when you're looking for playable gaps, first and foremost, see if there's volume in the pre-market. Okay, as you get away from earnings season, stocks tend not to get so much volume in the pre-market on these gaps. As a rule of thumb, anything under 50,000 shares of volume in the pre-market is considered thin. I mean, there are days where you're going to get a 5-point gap and there's only 100 shares. All right. Now, first and foremost, make sure that that's a real gap. Okay, it's not someone just hitting, a bid or an ask on a 3-point spread. All right. Number one, make sure that there's news too. All right. We want to make sure there's some kind of catalyst that's causing this. We don't want to judge the news or analyze the news, but what we do want to do is make sure that there's some type of catalyst. All right. And this is not to say that stocks that don't have any volume are not playable. They're just very thin. Okay, but you'd be surprised. Some of the more widely traded stocks barely trade any volume pre-market unless there's news. And when there's news, then you are going to have volume. So over 50,000 shares as a rule of thumb, unless you are very familiar with that stock. And stick to NYSE and NASDAQ stocks. I don't mess with Amex and we definitely don't mess around with bulletin board stocks. All right, so the fast chart analysis, once again, let's just review. Okay, you want to observe the 60 daily, weekly, monthly. Look for any overlapping bumpers. Bumpers are what? 5, 15 period simple moving averages, 20 period moving average, which is part of the Bollinger Bands, upper lower Bollinger Bands, and 50, 200 period moving averages. Those are the bumpers. Now, you don't have to record every single one of them because the reality is if the stock is too far away from it, all right, not very significant. If it's within the range of it, okay, if it's within a proximity of it, then jot it down. When they overlap, jot that down. Make a note of that. That's significant, especially say you get a weekly plus a monthly 5-period moving average that overlap and the stock's trading a point away from it, okay, that's something you want to jot down. Now, anytime there's a pup or a mini pup, what's the first thing that comes to mind? 5-period moving average, right? On the mini pups, 5-period moving average, and then what's the next direction? So if it's a weekly mini pup, write down that 5-period moving average. If it's a weekly mini pup, but the trend is coming down, then that's a tightening. So write down the 5-period moving average. That's support, and then the next bumper, which is going to be that most likely the 15-period moving average. Write that down. And then always note whenever you have pups or mini pups involved, okay, with any of these charts. Now, one more thing. With upper and lower Bollinger Bands on the daily, weekly, monthly, more notably the weekly and the monthly, especially on these gappers, okay, keep an eye on them. These are slingshot areas. So if a stock is gapped below its weekly lower Bollinger Bands, understand that obviously that acts as a resistance first, but if they pierce the lower Bollinger Bands, you can get a slingshot move up, at least for a temporary period of time. And the same thing on the upper Bollinger Bands. If it's gapped up above, that's going to be a support, but if they pierce it, gravity will take over and you're able to get a rug pull type quick collapse. Okay? So always note if the stocks are trading near upper or weekly, upper or lower weekly, monthly, and daily Bollinger Bands. And that's it. That's your fast chart analysis. It's not a whole lot of work. Just got to make sure that your charts are lined up. You may even want to have a new layout page that, just call it fast chart analysis, and just so that you can pull that stuff up. It's a data information gathering page, okay? But like I said, fast chart analysis, get used to it. You should be able to, with time, be able to just extract the key data, okay, under a minute. And so that means you're going to get to a point where, yeah, you know, you could literally have 7 points of data on each chart on the 60 daily, weekly, monthly, but you don't need all 7 points. Okay, you want to extract the most viable information, the overlapping stuff, the stuff that's got the pups and the mini pups on it and those bumpers. Let's take a look at OVTI on a gap down in the pre-market. Now over here we have the daily, weekly, 60 and the monthly charts, and the one thing that's very significant on OVTI that we notice is that the weekly lower Bollinger Bands sit at 1310. Okay, notice the weekly stochastics, yes, they've come down, but the Bollinger Bands is what we're looking at. That's the immediate thing. So 1310 is the lower Bollinger Band on the weekly. As far as the daily is concerned, it's got a mini inverse pump, but it's gapped way underneath the daily lower Bollinger Band, 1430. The monthly is very flat, not very significant. And as far as the 60-minute, once again, the 60-minute, that's we don't place too much credence on that. We just note that the obviously it's down, the stochastics are down, the 5 periods at 1350, so that's one thing we want to keep in mind. But we go into the day with the understanding 1310 on OVTI, that is the weekly lower Bollinger Bands. We know right off the bat 20 cents below that's 1290, so that's 1290 is going to be its coil support. And then underneath that, we know right off the bat 1250 is a stinky 250s level, so that means 1260, 50, and 40. Those are going to be the stinky 250s level. Initial supports, and then if they enter it, that's an area where OVTI can pretty much chop, and if they break 1240, then that could be the next leg of the breakdown. And there's your fast track analysis, okay? Pretty much done in about 30 seconds. So that's what we write down, and that's what we go into the open. So what I want to talk about is identifying maladies early on in your trading. And I hope you will agree with me when I say a poorly managed, a well-managed loss trumps a poorly managed win. Okay, because if you can't understand that, try. Because anyone can win on any single trade. Anyone can follow a trade alert and win without knowing what the hell they did. But then you continue to follow that path, and ultimately you're going to blow up if you don't know what you're doing. So maladies are just kind of like this picture of this glass right here. And you notice how the glass is cracked. Maladies start early, and they're almost invisible to the naked eye, but by the time you see them, by the time you see the ripples, and if you don't look to fix them, what happens? The glass will shatter. Okay? So what we want to make sure that we're doing is we're identifying maladies early on in your trading. So then that goes back to a well-managed loss trumps a poorly managed win. And a poorly managed win is an example of a poorly managed win. You jump in on a stock, the premises reverse on you, that perfect storm actually reverses on you. And you sit there and you're frozen, or you ignore it, or you can't identify it. And all you're looking at is the surface movements of the price, where it's only, chopping flat, not noticing or realizing that, hey, wait a minute, the SPY is grinding here. The SPY is in a perfect storm, and your stock all of a sudden stopped moving up. And then you don't notice that the 5-period moving average on the 5-minute chart, it just slipped. And then you don't notice that on the bounce, you tell yourself it's okay, but each bounce is lower and lower. And then the 5-period moving average is starting to cross back down. And then the next thing you know, your perfect storm reverses on you. And you don't do anything. And the stock collapses on you. and you wait all day and you sit through, I don't know, point and a half drawdown, but you don't take your stop, and then by the end of the day, that perfect storm is finally over. SPY takes a squeeze, and your stock somehow miraculously bounces, comes back to where you entered, and then it pops 10 cents extra, you're out, and you won. Whew. Wow, holy cow. That was a hard trade, man. But I walked away with a victory. I walked away with profits. Do you see what I'm saying? That is what's known as a poorly managed win. A well-managed loss, well, you get in. Let's take the same situation and try to visualize it. You get in, the stock makes an initial pop. You watch the futures. The SPY is in a perfect storm breakout, but you notice that your perfect storm is not playing out. In fact, it should be playing out. In fact, since the SPY is squeezing, your perfect storm should be screaming. And that 1 minute mini pup fades, reverses, slips the 80 band, about ready to make a 1 minute mini inverse pup, you take your stop. Bam. You're out. 15 cent stop loss. And then later, maybe 10 minutes later, when the 5 crosses down, mini inverse pups, the stock collapses. Well, you took a stop, you took a loss, but guess what? It could have been worse. That's a well-managed loss because you spotted it, you spotted the deficiencies with the premises, and you took your stop. And then you avoided further damage, a well-managed loss, as opposed to the trader who couldn't take the stop, couldn't understand why the stock wasn't moving up, waited all day long, and it finally came back for a 10-cent profit. And that is a clear example of how a well-managed loss overshadows and trumps a poorly managed gain. When you have situations like that, okay, that is a definite malady. And you need to be able to identify those things early on, guys. And that really means just pretty much being honest with yourself. All right? Being honest with yourself. There are times when you're lucky, okay? And they say it's better to be lucky than be good. Yeah, on a single trade, okay? But luck always runs out in this game. So make sure you know when you're being lucky. All right? Maybe that inverse pup breakdown and that perfect storm that is fading and it's moving against you, and then all of a sudden, I don't know, news comes out and the stock explodes and you get out. Okay, that's luck. Because had it not been for an unknown, unforeseen catalyst, you would have gotten nailed. Now, as you get more conditioned, you're going to realize, okay, as I've said before, stops are great. Precautionary stops, they're great. The other thing about stops is stops make you pay attention. Why? Because you're losing money, okay? And when you're losing money and you're going through a little bit of pain, that's when your attention is really going to be focused. And it's because of that focusing, it also gives you a better perspective of what's actually going on. Who better knows how weak a stock is when you see the futures screaming higher, when you see the SPY in a perfect storm breakout going higher? Who better knows how weak a stock is than someone who's long a stock, than someone who's long a perfect storm, and they see the whole market, the forest moving away, but meanwhile your stock is actually self-fading, right? You can't see that on a scanner. You can't hear that. You literally can't even really see that if you pull it up, because you saw something on a scanner, okay, or someone tells you this. When you're actually in and you have skin in the game, and I'm sure you know that there's something wrong with this stock. You know it intimately. What you're doing is by taking the stop, you're buying that information, you've purchased it. So as you get more experienced, you're going to take that information, and when you realize, hey, the futures, all right, here we go. They're reaching a coil resistance, they're reaching an overlapping resistance area, which means that the futures, they're going to go through a reversion. The 1 minute's going to peak out first and foremost and pull back. And you should know right off the bat, when that 1 minute peaks, pulls back, this thing is going to reverse. So you take your stop, and once the futures peak out, or you may short even ahead of the futures, and you take it to the short side in anticipation of the futures and the SPY peaking out, coming down, and next thing you know, bam, a reversal right back down the other way, and you make money. That's how stops work for you. And that embodies the whole essence of a well-managed loss trumps a poorly managed gain. Because that trader with a poorly managed gain, he's going to walk right into that minefield again, and he's going to do the same thing, which is cover his eyes and walk straight. He got lucky last time. That luck's going to run out. So these are the most common maladies. All right? Taking your exits too late, misreading the setups, ignoring stops, watching too closely, overtrading, and taking exits too soon. Can you take your exits too soon? Well, you know what? In the beginning, understand there is no such thing as taking money off the table too soon. All right? Now, if it becomes a habit, then that may become a fracture in the glass, because that just means that you're too nervous. You have too much anxiety. And you either have to step back and just watch it for a while, do it on a simulator, play 100 shares, play something light, but that's just anxiety taking over, because you have to have confidence in the patterns and the setups. So the taking the exits too soon, that's something that if you notice that you're doing that constantly, and when I say too soon, I mean taking it even before the impact, perfect storm breaks out, before even having an opportunity to profit from the trade, all right, then that can become a malady. And we're going to address all these maladies as we move forward here. All right, so here's an example of how maladies can sneak up on you. And usually it's going to happen during the afternoon or the end of the day. By that point, mentally and physically, you may be drained. Especially if you don't take your breaks during the dead zone. It's so important that you take your breaks, not just for any physical reasons, but you have a psychological, you have a mental sharpness tank, and that gets depleted anytime that you're really focusing hard. Okay, that's my theory, that it gets depleted, and you only have a limited supply of that every day. The only way you can really replenish that is to take a break, okay, away from the screens. Because even though you may stop trading, if you're still eyeballing the charts throughout the dead zone period, okay, subconsciously, those are all cognitions that are being fed into your mind, and very easily, believe it or not, very easily, in a subtle way though, in a very subtle way, it can basically shape your frame of reference and draw you in, so that perhaps you are just focusing on just a few aspects of a potential trade or a trade, and watching the leaves while the force may be moving the other way. In other words, it's so easy to get caught up that you're actually watching the tip of the iceberg. You've been minimized to a point where you're just watching the shallow tip of the iceberg, no longer aware of the dangers that lurk beneath. And this is an example where on DDD, okay, it's coming into the end of the day, and around that 2:30 time frame, you may have been watching DDD, and whether you jumped in or not, but you saw how DDD has been selling off from the mid 75s on the 15-minute downtrend with mini inverse pups. you notice that the 5 minutes been in a downtrend, okay, all the way down to that 74.50s area, the Stinky Fives lower range. And you also notice that the 1 minute is not getting much by way of bounces. So at this point, it's very easy to look at the charts, and at the 15-minute chart shows a mini inverse pup. The 5 minute shows an inverse pup that's starting to form, okay, on a 74.40 break. 74.40, you already know, well, that's the Stinky Fives area. If they break that, that could open up the floodgates. You carefully wait for the 1 minute to finish its bounce, peak out, and you notice that the 1 minute mini pup's starting to get faded. And at this point, you step right in and you short it at 74.39. Now, as you get this short at 74.39, all right, you get the counter candle break on the 5 minute chart. The 1 minute's got a mini inverse pup. The 15 minute has a mini inverse pup. And DDD downticks really quickly through 74.30. You're thinking, all right, this is good. This is good. This thing's ready to roll over. It's ready to collapse. And it downticks to 74.24. At this point, you might be patting yourself on the back saying, all right, good job. I caught the Stinky Fives lower range break. And then the next thing you know, this thing snaps back. The 1 minute coils off the 20 band. The 1 minute coils off the 20 band and slingshots right off that 20 band straight back into the Stinky Fives area, 74.40, 74.50, and peaks out at 74.60. And at this point, you're shaking your head. You're thinking, all right, no. The 15 minute has a mini inverse pup. The 5 minute got a mini inverse pup through the 20 band. I'm just going to hold on to it. And so it peaks at the 74.60 area and pulls back down to the 74.30 area, so you're feeling okay. And then they spike it back up to the 74.50. It chops back down to the 74.30s. At this point, you're just watching the shallow price action. Okay? In your mind, you're thinking, all right, I'm glad I didn't panic out at 74.60. All right, okay, the 1 minute's crossing, 1 minute's making an oscillation up, but it's still choppy in the Stinky Fives area, 74.60 to 74.40. Okay, it overshot to 74.30. Ah, darn it, here it comes back. It coiled back again. And then by 2:53, 2:54 p.m., all right, you see the 1 minute trying to make a mini inverse pup, but then they cross it back up, and at that point, you're starting to get worried because your 5 minute mini inverse pup premise has now, well, it got taken out because the 5 minute stochastics have not only crossed up, but now they're crossing the 20 band. All right, so then you look at the 15 minute chart and you realize, oh crap, 15 minute, even though it's still down, all right, this thing could cross to the upside. And so as you're watching that 1 minute and you're holding your breath, hoping at this point that this thing crosses back down on the 1 minute chart, rejects off the 80 band perhaps, the Stinky Fives levels, holds resistance hopefully. It dipped back under 74.30 twice very easily. So you're telling yourself, all right, I'm not down too much. 74.60, if they break that, then maybe I'll keep a stop. And then as the 1 minute test the 74.60, and then it spikes through the 74.60, you start to get worried. Get a pullback to the 1 minute 50 period moving average in the cyan blue, and then the next thing you know, the 1 minute forms a mini pup and spikes up to 74.90s. And at this point, you're telling yourself, oh, these algos, it's the algos. And you look at the 5 minute chart, and you realize you messed up because the 5 minute 5 is now sloping up. The stochastics have crossed up firmly and is trying to form a mini pup. You look at the 15 minute chart, no mercy there because the 15 minute just crossed to the upside. Damn. And now instead of taking a 14 or 10 cent profit that was there, which you figured you'd get a panic going into the last 90 minutes of the day, instead of a 15-cent profit, you're now looking at almost a 50-cent loss. And at this point, you're basically trapped. And the algos, they know this. And so sure enough, they're going to jam it. They're going to jam you. And that's what they do. They proceed to jam on a 1-minute mini pup spike up towards the 75. They break 75, 75.05, 75.10, 75.15. They spike it up through the 1-minute 200 period moving average. And it's at that point where you will likely cry uncle and stop out. So now you stop out with a 60-cent loss. And you ask yourself, how the F did that happen? I had a profit. I should have taken the profit. But realistically, if you know how DDD trades, okay, that thing can absolutely slingshot against you. You can say that there was a possible 14-cent profit on that, but you got to be realistic. Okay? Not taking that profit pretty much implied that you were expecting a bigger rollover, a lean down, a much harder lean down. And then when it went against you, you just couldn't justify taking a stop loss at this point, especially after you've been watching this thing the whole time. And then it's that doubt, and DDD, okay, has a habit of spiking and then rug pulling real quick. And it's those rug pulls right back, they spike it up to 74.60. Oh, crap. And then they rug pull it back down to 74.30. Whew, okay, stay the course, stay the course. And so now you're so glued to the shallow action that you're not seeing that the 5-minute mini inverse pup was at hit a very low band and crossed up. The 15-minute mini inverse pup, when you took it, it formed that at the 10 band. There's a big difference between, an 80 band, 40 band mini inverse pup, okay? Even a 20 band mini inverse pup, as opposed to taking a mini inverse pup on the 10 band. So you are very close. You're taking a very risky trade because the 15-minute is so low. And in order for them to cross stochastics up, what they really want to do is knee-jerk it and get a capitulation sell-off, knee-jerk, rug pull, get the sell-off, and then spike it back up into the candle close. And that's going to cause the 15-minute to cross up on the stochastics and seals the tomb and traps the bears that come in late, which is what could happen to you. This is how maladies sneak up on you. You start off with the right premises, but perhaps you don't take the context into the premises, number one. Okay? Perhaps the SPY was bottomed out too, and the SPY turned around. Well, that's going to affect momentum stocks. Okay? Perhaps, look, when you take low bands like that, you have to know that these things can snap back at you. So the allocation is very important. Okay, but one way or another, it's easy to fall into that. Perhaps you played DDD earlier in the day with success. Perhaps you played it in the morning and you caught it beautifully because there was a lot of liquidity and it moved so fast. Then it started to get rigid through the dead zone, and so you feel like you got a handle on it. This thing can't get too far away from me. I'm in control. And then when they spike it like that against you and then continue to dangle the carrot because they keep rug pulling it back down, so it wiggles right back down under 74.40, wiggles right back down to 74.30, okay? That gives you some false hope that, hey, this thing could come back down. But see, when you get to that situation, that's when it's easy to lose sight of what your original premises were. If it's a 15-minute mini inverse pup and a 5-minute mini inverse pup, those are valid premises. But it's at that point you got to ask yourself, do those premises still hold water? And the answer is no. 5-minute cross back up. There's no mini inverse pup left. 5-minute cross back up. The 15-minute mini inverse pup, cross back up. There's no mini inverse pup there. Well, what about the 1-minute cross back up? In other words, this would be a long trade, not a short trade, but you're stuck now in the short trade. So it's important that you don't lose sight of your original premises. It doesn't mean you can't be wrong. You can be wrong because the premises change, and you should always be taking those stops out. You can always be sharp enough to take those stops out. Now, the other thing is, well, I took smaller shares. Even if you took smaller shares, nobody likes a 50-cent stop loss, 60-cent stop loss. Smaller shares don't mean anything if the premise is reversed. You took the smaller shares to be able to withstand a wiggle to the 15-minute 5 because it's a mini inverse pup, or the 5-minute 5 because it's a mini inverse pup. Willing to give it one count. When the 5-minute 5 starts to slope up and forms a mini pup against you, you look to the 15. If the 15 stochastics have crossed up, you need to be out of there. You need to be out of there. Okay, so you just use that example of what not to do. And trust me, everyone has been through that. And you can still fall for that. The important thing is that you catch yourself early, step back, cut your losses, okay, step back, and move on. So, let's say you've identified your maladies, okay? Let's say you realize in the last few days you've gotten really lucky. Last couple days you've really had to pretty much scale in and do defensive sprawls to add, and you barely made it back by the skin of your teeth, literally catching the very small window of liquidity, but you caught it. And kudos to you on that. But let me tell you something. When you find yourself averaging in shares a lot, okay, that is a sign. That is one of the most definite signs that something is about to crack. Please take my word on that. Whenever you play these perfect storms, most of the times, okay, they should move in your favor. If five of your last trades in a row, you're getting in, and then it moves against you, and you're scaling in, and you're getting out break even or with a small profit, that's not a good thing, because it's telling you either you're reading your premises, the premises are reversing on you, and you're not reacting in time, something wrong with your management, or there's something wrong with the market. And yes, the markets can be wrong. Something has shifted in the landscape. It may be a dry climate, and it's screwing with your premises, and it's screwing with the correlations. The markets, let me tell you, when it comes to dry climates, you can have some pretty strange dry climates, some very strange bipolar climates, segments of the dry climates. And understand that. But let's think of a worst case scenario. All right? And that is going on tilt. The tilt is the abyss. That is where you lose, you get frustrated, you start leveraging up, you max your leverage, and you just can't get a winner. And you get deeper and deeper in the hole. You're on tilt. And you know it. Well, there's a 3-step reset process that you have to go through. All right? And I want you to really listen carefully. This comes firsthand. I've blown up many times before. Almost every trader I know, every good seasoned trader I know has blown up. Okay, it's nothing to be embarrassed about. You learn from that. You grow from that. You have to evolve from that. And this is how you learn from it. or else you're just going to continue blowing up, blowing up, blowing up, and you know it's not going to be pretty. So the three-step reset process, and when I say reset, it's just like this image here. You broke something, okay? You broke you broke your arm, you broke a bone, and when you break a bone, what do? They reset it so that it grows back properly. They put it in a brace. It's under it's under a very strict setting. And this is the same thing that you've got to do. So step one, be the hammer. Just like a hammer candle is a capitulation candle, right? That's it, done. Why is a hammer a reversal? Because a hammer will show the worst, but it will close with some optimism. Buyers will come in, and thus the hammer. Step two, investigate like a CSI, crime scene investigator. Be honest, backtrack. When did your maladies start occurring? Yeah, man, well, I started, doing a lot of sprawls for the past 3 days. And that's why I took a major hit today, right? So you didn't realize that you were taking all these sprawls, because in reality, like I said, most of your trades, when you get in, that sucker should be jumping because you're playing perfect storms. And then step three, the repair and recovery, the rehabilitation. And whether it's a serious malady, okay, string of maladies, okay, or subtle strings of maladies, the earlier you catch them, the better. So let's go over each step. Be the hammer. All right? Now, if you're on tilt, it's going to be very hard to stop, okay? Your office manager, okay, or the fund administrators may already have caps on your daily losses, and that's a good thing. That is not a bad thing. That is a good thing, and for both of you. But if you're in a situation where you are going on tilt and someone can't manually cut you off, the best way for you to actually stop, other than blowing up, okay, well, let's go back to what we talked about in level 1. The 3 remedies for impediments, the 3 remedies for afflictions. That is to counter, dilute, or divert. Counter, dilute, or divert. So in a situation like this, where you're getting hammered out there and you're upping your size, and you're just in a situation now where you're just watching every tick, and every time you enter a stock, the damn thing down ticks, and you're tired of taking all these little losses, so you decide to hold on, and then you totally ignore that the whole thing is collapsing against you. You finally stop out, you reverse the trade to the short side, it bounces back up against you. You're so frustrated you can't stop. Situations like that, in order for the mind to stop, give yourself a little bit of optimism. A single winning trade. Be the hammer. And remember, the hammer candle is what? It is a capitulation that starts off at its worst and then closes with a little optimism. And for you, trim down your size. In fact, it ain't even about the money. It's not about the money. It's not about how bad you suck. Get one single winning trade. That's all. I don't care if it's for $1. I don't care if it's for two cents. Okay? Get a single winning trade, one green trade, and shut it off. And shut it off. So at least you close the day with a green trade. I know it sounds stupid, okay? Let me tell you something. If you have ingested everything that I've been talking about from slide 1, then you should be acclimated, and you should understand what candles represent. And you should know what a hammer candle is. And by knowing that, by being able to identify that subconsciously, it's a start. It's a turning point. One positive trade. Don't care if it's a lucky trade, okay, at this point. shut it off after that. Have a little bit of a silver lining. Have a little bit of a capitulation so that you don't close on the absolute low of the day. Just a little green trade. Done. Shut it off. Now, later in the day or the next day, what you need to do, because this is a scene. This is a crime scene. Someone got robbed. Someone got mugged. Someone may have gotten murdered. Okay? So this is a crime scene. And as with any crime scene, you got to go back and look at the evidence. And not just that evidence with the body, with the carcass on the floor and the outline of the body, but you got to go back for the prior few days and see if there are any clues that would have led up to this incident.